welcome everybody. Very happy to have you attending this class, which frankly is my favorite class, 1031 Dessert. And it is dessert. It's just all the good stuff we can do with 1031, just the fun stories. So you'll see those as we go through. You know, the subtitle, Achieving Business and Personal Goals through 1031 Exchanges. This is all the happy news of 1031. For those of you who don't know me, again, I'm Toya Butler. I'm an attorney. I have been doing this work now for 28 years. I should stop counting. And really, it's satisfying work to help folks achieve business and personal goals. Of course, 1031 is all about tax law. We're not going to talk tax law today. We're talking about the cool results that we can achieve with the 1031, and I've been at it for a few years now. Mark Adams is speaking as well today. Mark, would you introduce yourself?
Sure. Thanks, Toya. Mark Adams, been with Butler Exchange Group a little over a year and a half. And I really enjoy the work. It's really been amazing to me to see all the different things that 1031 can accomplish in the utilization of the 1031. So before joining Butler Exchange Group, I was in private practice. I focused on business law, did some estate planning. I also have a public accounting background, as well as own my own business for a few years. So like I said, been here about a year and a half, and looking forward to sharing this presentation with you all today.
Thank you, Mark. And a point too, I didn't say, but I'm a real estate attorney, and I do not have the tax background. Mark has a stronger tax background for this material, but of course I've learned a lot in those years. One thing just to give you a finger on the pulse of the business, with the COVID virus, yes, we did take a real dip in business in April, but it came back strong in May, and last month we set up 98 exchanges. On average, we're usually setting up about 100, and so we are really almost back to normal again, which we did not expect. So I would tell you that for our purposes, it's almost back to normal. Keep in mind that our work is largely residential rentals, duplexes. I think Mark ran a survey, and about 70%, Mark, was it? 70% of our transactions are $355,000 or less. They're small deals. Those are the deals that are back. Yes, the commercial transactions that normally come through here have slowed, and those are struggling for any number of reasons, financing being one of them for sure. But we're pretty much back to normal. So I think that you're going to be seeing exchanges more or less in the same way that you have in the past. I want to launch our first polling question here, and it really we'd like to know who's in the room. So when you see this, if you will respond to it, the class is designed mostly for realtors and brokers to get credit hours, but it's nice to have some of our investor clients join us. I see it looks like we've got a tax person or two on, a few maybe. I'll give you the numbers here once everybody's kind of voted, if you will. So we like a nice mix in the room, and unfortunately we aren't able to have the interaction that we could in a live class. It's fun when all those professionals can pass information back and forth and chat. So we don't quite have that opportunity today, but we do have the questions, and Mark and I do welcome your questions as we're going through. Each scenario that we're going to look at is unique, and we will take your questions pertinent to that scenario as we're going through. It looks like most everybody's voted. I would say it looks like 31 of you are realtor brokers, 10 are investors. We have 7 tax folks in the class today. No attorneys, so far as I can tell. Couple of lenders, 5 in the other category. And I'm going to guess that some of those might be financial advisors. Maybe it's financial advisors. We tend to see a lot of those folks attending these meetings as well. So a nice mix in the room, and it may in fact lend itself to the kinds of questions that you will be asking. All right, so I'm gonna take that down for a moment and move on then to the the class. So again, as I said, it's 1031 Dessert. It's not rules. It's really stories, business goals that are achieved with 1031. Personal goals. And if you recognize any of your clients in these scenarios, you recognize that that is a business goal for them. You recognize that that is a personal goal for them. If you can bring this idea back to your client, Well, it actually kind of makes you the hero because you've alerted them to something that's a possibility. And if they can achieve that business goal or personal goal and not have to pay capital gain taxes, because that's really what 1031 is about, is not paying tax, and may I say, not paying tax now. It's a deferral. The tax bill didn't go away. But if you can help them achieve that business or personal goal and they don't have to pay the tax now, which means they have more money to work with in terms of financing replacement property, then you're really the hero. And may I point out, in any successful exchange, there's a relinquished property, there's a replacement property. And as a broker, double commissions. So you have to recognize each of these stories as a commission opportunity, and you may in fact see stories where if you're working on both ends of the deal, they're selling 1 to buy 2, selling 3 to buy 1. About a third of our exchanges, there's 3 or more commissions in there for you. So commission opportunity. With that though, I do want to turn it over to Mark, who will cover a few of the rules that we have to cover in this discussion. So
All right.
Mark.
Yeah, yes, it is 1031, so of course there are rules, and I'm going to cover 3 of the foundational rules today. And if you have questions anytime along the way, please feel free to type it in and we'll address it, in real time. So the first rule I want to talk about is the identification rule. If you've done a 1031, if you've had any exposure to 1031, you know that there are deadlines and they are critical. So the first deadline is the 45-day deadline to identify property. So the day the sale closes, you have 45 days to identify generally up to 3 properties and 180 days to close on the purchase of one of those properties. Those timelines run concurrently. So 45 days to identify, 180 days to close. And how do you do a successful identification? Well, there's 5 components to that. One is it must be written, it must be signed, it must be delivered to a party of the exchange within unambiguously. So it must be written. So it can't be a phone call. It must be signed. It can't be a typed email. It must be delivered to a party, and that is generally the exchange group, like us, and we would provide a form at the time of closing that allows you to identify the property properly. Within 45 days, and that 45 days, like I said, starts the day of the close. Day 1 is the day after close, and 45 days must be 11:59 p.m. on the 45th day. Don't test that, but people often do. I had a client last year who decided he would be funny and send it in at 11:55 p.m., which gave us a little bit of stress here, but we encourage you to do a little bit sooner than that. And it must be unambiguous. And what is unambiguous? Well, just as it states. So you cannot send an address in that says 123 Main Street with no town, no state. It has to be an address that's easily identified, unambiguous address. And if you are doing a fractional interest of a property, you must also identify that. So if you are buying a property as a tenant in common, as 50-50 ownership, you must identify the 50% of that property that you are buying. So those are the rules of the identification. So I do want to address one more thing. There's been a lot of discussion over the last several months about deadline extensions and what is the IRS doing. And the important thing to remember is that those deadline extensions were granted, but they will only apply from April 1st through July 15th. So if you had a 45-day deadline or a 180-day deadline between April 1st and July 15th, you had an automatic extension to July 15th. That is obviously next week. There are no more extensions in the works according to the IRS at this point. So there are no more extensions. So if you're not in an exchange now, you will get no benefit for those extensions. So basically the extension is gone. We answer that question 3 or 4 times a day still because there has been that discussion out there of these extensions around 1031 exchanges, but it's just not going to be a reality going forward. So that's rule number 1, is the identification. Rule number 2 that I want to talk about is reinvestment. Another question we get very often is, I want to do a 1031 and I have X amount of gain in that property and I want to roll over that gain into a new property. That is not how the 1031 rules work. You must reinvest to defer all of your gain. You must reinvest the amount that you sold the property for. So if you sell it for $500,000, you do get to take off realtors commissions, escrow fees, our fee, and you have basically a net sales proceed amount. And then to defer all your gain, you will need to buy at or above the net sales proceed of your relinquished property. So you can definitely buy something for less, but you would then be taxable on the difference between that net sales proceed amount and whatever you buy for. We do that all the time. It's a partial exchange. It's still a very good exchange, but you have to understand your tax ramifications when it comes to doing a partial exchange, where your basis is in your property that you're selling and what you're buying. You need to make sure you're buying over your adjusted basis. Again, it can't just be the gain that is reinvested in a 1031 exchange. It has to be the full amount. And the way it was explained to me when I first started was, when you sell a property, you have X dollars invested in the American real estate economy. When you go buy a replacement property, you want to have the same X amount of dollars invested in the American real estate economy. It's not just a gain deferral. It is a gain deferral, but the whole point is you're keeping money invested in the American real estate economy. Third rule, and the best rule probably in 1031, is like kind. What does like kind mean? Well, as of the beginning of 2018, it no longer includes personal property. So that is one area that is out. But what is real property? And the IRS just clarified some of these in some temporary regulations that they just issued. Basically, real property is anything from a single family residence to multifamily to triple net lease to bare land, commercial property. You really have a wide range of options when you're talking about real property. And you'll see some of that in some of the scenarios that we're going to cover in our examples today. So again, like kind, very, very generous. It also includes, and I'll talk a little bit more about this later as well, is a DST, which is a fractional interest, ownership interest in a property, a large property. It's similar to a REIT, although a REIT is considered a partnership interest. A DST, Delaware Statutory Trust, is actually a real property interest in a property. It can be a senior living facility in the Midwest. It could be student housing in Texas. It's a big facility that you are a small ownership percentage of. You're on title to the deed, and there's a whole list of things that you need to understand around a DST. We won't get into that too much today, but it is an option and a very suitable option for the right type of exchanger. So that is it for the rules that I wanted to cover, and I will turn it back over to Toya, and she will start with some of the examples that we have in terms of the 1031 exchange.
All right. Here comes the fun part. Yes, Hannah?
I was just going to say, we did have one question on what qualifies. Kristen wanted to know if timeshares count.
Oh, let me take that. Deeded timeshares would qualify as replacement property in a 1031. Deeded timeshares. A couple of things to consider, though. Generally, the timeshare isn't going to be enough to fully offset their sale. They sell for $100, they buy a timeshare for $20. They still will need a second property to make up the differential to keep them fully invested, as Mark described. And then the other thing I sort of, josh about is that, of course, 1031, our clients are invested in a property with gain. If they take some of those dollars and buy a timeshare, well, they might not, there might not be any gain in that timeshare over the coming years. But a deeded timeshare actually does work as replacement property. We just need something more to fully get our client reinvested into the economy. So that was a good question. I haven't had that one for a while. Okay, so we're going to start into the stories. And a couple of things. First of all, they're going to fully illustrate what Mark was describing in terms of like kind. That's really so much of what's going on here, are these cool outcomes. And these are stories, live stories that we've experienced in the office. And when I created the outline in the first place, I just wrote down all those stories. And then to organize, well, I just realized that like half of these are personal goals and half of these are business goals. So that's the order we have here in our presentation today. And also what you will not see, but is in every one of these scenarios, the exchange company. So we talk about selling a property, buying a property, selling a property, buying a property. That's all you're going to see for language here today. But the truth is none of these works unless there's an exchange company in the mix with our paperwork in each of the closings, right? Because that's what we're paid for, is documentation in the closings. So you won't see us mentioned, but we have to be participating in each of these for it to qualify. So I sort of love this first one. It was a mom, and we've had several, it's not just one, but the one story I think of, mom is selling a rental in Pullman, where she had a house, kid was going to school, and this mama is on the phone with me, and she's just so happy because her baby is going to med school, and she's just delighted about that, going to med school. And so she's selling a rental in Pullman to buy a rental in St. Louis, where the kid's going to go to school. And if I may kind of summarize the like-kind rules that Mark went through, in each of these scenarios, you're going to see only 3 types of real estate: rental, commercial, or land held for investment. So every scenario is rental, commercial, or land. And then what is like-kind with that? Well, land or commercial or rental. What do they want? So here mama is selling a rental in Pullman, and it must be a rental. I'm not quite sure. Kid had to be paying kid had to pay fair market rent to mama. And we have seen a couple of cases in the last 5 years or so that make it quite clear. If a family member is living in that property and it's going to be 1031 eligible, fair market rent. So, well, how did the kid do that? Well, they were, burning the midnight oil. Mama. Mama is going to gift, if you will. She is going to show on her tax return that she got fair market rent. And it was essentially her gifting to her kid. Now, I know there might be a couple of other roommates in that house. They're paying their rent. But if mama's kid is living there rent-free, I think that's problematic. So we want mama to show fair market rent for the property. Part was from the roommates, and part was essentially her gift to her kid. She didn't really hand him the money and they hand it back, but she shows she got it. And we believe that is very solid, a gifting arrangement to bring it up to fair market rent. Then when the kid gets to St. Louis and med school, same thing. It's got to be a rental on that end. The property being sold, the property being purchased, both have to fit into one of these categories of rental, commercial, or land. But very happy mama. I'm a mama of 5 kids, and none of mine are ever going to say that to me. They're all liberal arts kids. Nobody's going to med school. Their math skills aren't there, much to their engineer father's dismay. So, personal goal, and a pretty cool one. A client of ours was selling a 4-plex, and what he wanted to buy was a commercial building, actually, and I think it was in like Coquille or something. It was a small community, and he wanted to sell the 4-plex to buy a commercial building that he was going to make available to his church. Church had some program that they wanted to house there. And so he was out of a 4-plex into a commercial building, like kind. It doesn't sound like kind, but it absolutely is. The one thing I did suggest to him was that the church should pay him some sort of rents, fair market, for their use of his building. It may be a gift from him to the church so that he shows the fair market rent. But he needs to have some sort of rental income. But I wouldn't have expected, I imagine some commercial building that's been vacant for the last 8 years. And so he buys it, which is wonderful for the community. And the fair market rent for that probably couldn't have been very much. But out of a 4-plex into a commercial building, absolutely like kind. Mark.
Oh, all right. So in this situation, a client sold a duplex, had found a great lot on Lake Chelan, and wanted to exchange into that lot. So does this work? Yes, it does. It's like kind. So there's a couple of things in this scenario that we wanted to discuss. So the first is, if you exchange from an improved property, such as a duplex or rental home, into bare land, you are able to do that. However, and you will defer your gain, but what you will not defer is the depreciation recapture associated with that. Because the lot has no improved structure on it to carry over your depreciation schedule, the depreciation recapture must be reported on the tax return. So anytime we have a scenario like this, we always say you really need to understand what your depreciation capture liability is, because it can be significant if you've owned a property for a long time and taken a great deal of depreciation on it, and that depreciation recapture number is a big number. You're going to want to know that before you do the 1031 exchange, because sure, deferring the gain is great, but you could still have a fairly significant tax liability on the other side of it. Now, what this person wanted to do is they indicated that they might want to build their vacation dream home on this lot in the future. Now, I emphasize might because that is critical. If their intent was when they purchased this lot to build a home on the property right away, and they had retained an architect and started applying for permits and really started moving down the road of, planning this dream home, then you could really have some issues in terms of the viability of the 1031 exchange, because you wouldn't be investing or exchanging into a lot for investment purposes. You would be exchanging into it, and your intent would be measured at the time that you exchange into that property. So that's the critical aspect of it. You can definitely exchange into bare land, but if you intend to use that personally, you need to wait for a long time. And again, they said they might be doing it, and it would be 5 to 6 years down the road. So there was no, imminent indication that they were going to be using this property personally. It really was an investment in this property. So that is that slide.
One thing, Mark,
Yes.
a couple of things actually. So one thing I'll say about that particular scenario, the gal had only owned the duplex 2 years. So thank goodness. She found out real quickly she did not like being a landlord. So she only had 2 years of recapture, so it wasn't going to be too painful, but you're right. That's pretty critical for many other folks. We do have a couple of questions, and I think we should take these now. Tim Steele is asking about identification. If you have separate parcels that run as one complex, like 4 duplexes, but you're running it as an 8-plex, does it exceed the 3 property identification requirement? Mark, do you want to take that?
So
Or tax law?
so the general rule is if you could sell the properties separately, then they must be identified as separate, items on your identification form. So, there's another rule. There's a 3 property rule in the identification. There's also something called the 200% rule. And what the 200% rule states, and this is how you can identify more than 3 properties. So if you were in that scenario that Tim mentioned, this might apply. So the 200% rule applies. You can apply it if you take your gross sales price from your property that you sold, and you basically take 200% of that number, so twice that number, and then you identify however many properties you want to, as long as the aggregate value, fair market value of all of those properties does not exceed 200%, you are okay and within the identification rules. Now, how often is this rule used? It's really difficult to use in a lot of these scenarios, especially on the West Coast and in areas where property values are as high as they are, because you run out of room pretty fast if you're going to be identifying 4 or more properties and you're really looking at 200% of the sales price. We see this most often when somebody sells a larger property and then they want to buy either a portfolio of properties or many smaller individual properties, and they want to have their options so they can list a whole slew of them and then select the ones they want to end up purchasing. But the 200% rule is an avenue to list more than 4. In terms of, can you list all together, accumulate a whole, 2 4-plexes into an 8-plex on your identification? Probably not. The IRS would look at that with some pretty significant scrutiny if they ever pulled, the file for audit. So you really need to be careful in terms of, if it could be sold separately, it really needs to be identified separately.
And we're getting several questions about making improvements. So let me address that. And we don't have improvement exchanges as a scenario in this, and I guess we should add it. So these questions about, is there some way to buy, raw property, and can you, put new construction on there, build a rental on there? So yes, and the word I tend to use here is theoretically. Theoretically, it's possible to make improvements as part of the exchange. What are the challenges? Why is it so theoretical? Because 2 more rules. The work has to happen, first of all, before our client becomes the owner of the property. Well, how are we going to build a new construction on that lot at Lake Chelan if our client doesn't own it? Well, that's the rule. So the way we do these, we only do a couple a month. We might take a couple calls a day, but they turn in only to a couple a month. And Butler, the exchange company, has to be the initial owner of the property. So we're going to be the temporary owner of the property. That's the first rule. We'll be owner, not our client. Secondly, 180 days, of course, is still the deadline to complete the exchange. and not complete the construction, but complete the exchange. And so honestly, we seldom do improvement exchanges because new construction, 180 days, it takes so much pre-planning that often our clients been working on the thing for a year before they sell, triggering the 180s. We sell on a Monday, buy on Tuesday, and Butler's the owner on Tuesday, and Wednesday the contractor's in there breaking ground. So you see there's been a great deal of planning before the sale ever even closes of the relinquished property. To get enough value in the 180 is the challenge. So theoretically it is possible. Renovations are easier to do sometimes. We're only trying to do $100,000 of work. Conceivably that can be done. I will tell you this, that these improvement exchanges are, they're custom. There's no cookie cutter for improvement exchanges. So depends on what they want to do, where they want to do, whether there's a lender or not, et cetera, et cetera, et cetera. And so it's not possible really this would be a half-hour discussion if we were going to really get into improvement exchanges. So I'll hold off there. Hannah, I'll leave it for you to clear up the questions that I'm trying to answer here. I'll answer.
There's one that we can, so what about going from bare land to a commercial building? Yes, you could absolutely do that. That's not an issue.
Yeah, great. Okay. Okay, I think I'll answer some of these others and typed answer later on here. So I want to move on to Mark's next scenario.
Okay, so the next scenario, and it's probably one of, I think the next slide, one of the most popular things we get in this office, and it is really 1031 is really utilized for it, is client is selling a house at the beach and wants to buy a property in Phoenix, a rental property in Phoenix. Does this work going state to state? Yes, it absolutely does. And again, this could be any number of scenarios, but this is the one that we're talking about here. So we can do this. And one of the components of this question we get fairly frequently is, what if I want to live in that property, at some point? And the answer to that is absolutely. You could exchange from a property at the beach into a house in Phoenix, and then in 2 years, you could make it your primary residence, or you could convert it to a second home. Now, I say 2 years because there's very little guidance in terms of timelines when it comes to the IRS and how long you have to hold property for. But this is one area where there's very specific guidance. The IRS issued a revenue ruling on it, and in fact, created a safe harbor. So if you buy a property in a 1031 and you have 2 years of rental, then after that 2 years, you are able to move into it or do with it whatever you want. Now, in that 2 years, you have limited personal use. So limited personal use is 14 days in the first year and 14 days in the second year of personal use. And personal use includes use by you. It includes use by your relatives. It would not include use by friends if friends pay fair market rent for that rental. So those are the key things to remember. It also excludes work days. So if you have to spend a week at the property painting and fixing things up, 1 week out of the year, that works. That does not count on the 14 days of personal use. Now, the following question we always get is, how will the IRS know whether I was working on the property or not, or whether I was there or not? Well, it's like anything when it comes to reporting your taxes. You have to have some substantiation, whether you're working on the property, whether you have receipts, what those dates on the receipts are, how you would show that. If they said, how would you know if they were there or not? Well, generally this isn't going to happen, but we've heard stories that the IRS went out and pulled, utility bills to see usage, talked to neighbors to see how long you were there. Again, this is probably not common, but it is something to be aware of as you're trying to show that you limited personal use to your 1031 exchange property, if this is a scenario you want to go down. The other question we get is, if you sell in Oregon and buy in Arizona, what reporting requirements do you have to the state of Oregon? Well, in the last few years, Oregon has decided that if this scenario occurs, you must file a return, basically an informational return with them every year that shows that you still own that property you exchanged out of Oregon and into another state. Basically saying, I still own this property, because once you sell that property, you are going to owe Oregon tax once the basically deferral period ends. Remember, 1031 is all deferral. You're just deferring the tax that you're going to pay once you ultimately sell that property. So Oregon doesn't want to give up that revenue, if you will, that tax revenue, by watching a sale, be exchanged to out of state and never realizing the value of the capital gains tax that they would have imposed at the time of the sale. So that's really it. And then the last thing I'm going to mention is if you utilize that scenario where you sell a property, buy a rental property for 2 years, adhere to that safe harbor, then you move into it, make it your primary residence, you live living in Arizona, having a great time, for 5 years, and then you decide to sell that property after 5 years. So now it's been your primary residence for 5 years, or for 2 years, 2 of the last 5 years. You can sell that, and there's some allocation done. You don't get off scot-free. You still have some allocation. Basically, the amount of time it was a rental versus the total amount of time you owned it is the fraction of the gain that you will pay on that. So there is tax due. It's less than it would have been if you kept it as a rental the whole time and sold it. But it is a nice scenario and pretty useful for people that want to basically exchange into a place that they want to end up living. So.
I will say this is our most popular scenario, is buying something. Oh, I didn't advance the slide. Sorry, Mark. There's the slide. This is the most popular scenario that we have in the office. I would hazard a guess that maybe a third of our exchanges, our people didn't want more real estate. But if they can get a place in Phoenix, well, okay then. And I will say this, that IRS has looked at this personal goal a number of times, and Congress as well. And in the course of my career, there have been 3 new rules, they were new at the time, 3 rules introduced saying, okay, you can do this, but, and they'd come up with another rule. And then, okay, that's okay for 1031, but here we're going to have another rule about that. So they have really tried to slow people down on this and layer some rules on, but it's still a very nice option for people who would like to have that second home in the sun or in Hawaii or whatever. So very popular exit strategy, I guess you might call it.
And before we, sorry.
Go ahead, Mark.
Oh, and before we move on from this, because it's a question, again, that always comes up. So there is that safe harbor, 2 years, limited personal use. What happens if and that's a vacation rental, second home situation. What happens if you have a full-time renter in there? So again, there's no clear guidance on it, but the prevailing thought is that if you buy a property in an exchange and you have a full-time renter for 1 year, that after that first year, and you've had fair market rent for 1 full year, that after that first year, then you've satisfied that requirement and could utilize it for enhanced personal use. So again, no clear guidance on that, but there's some thought around that 1 year of a full-time renter really is indicative of the intent for you to have, which is the measuring stick for the IRS when you exchange into that property. So.
There's a tax question that I want to answer real quickly here. So the question is again about selling improved property to buy land, that depreciation recapture. So if we sell improved and buy bare land, that's going to get recaptured, that depreciation deduction. There's no way to shelter it, even if buildings are put on the property later on. No, at the time of the exchange, if we acquired what was bare ground, that recapture is going to happen, even if construction takes place later. I've actually had scenarios where clients were buying, a piece of farmland. Okay, it had some structures on it, barns and what, they weren't in very good condition, but their tax advisor felt that the depreciation in the building sold could be transferred over to these ramshackle buildings on the new property. But without any structures at all, it's going to get recaptured. Oh yes, so let's see, where are we at here, Mark?
So,
I'm looking at.
Yeah, I'll take the question. Basically, my goal is to sell a rental home in Oregon and purchase one in Idaho, was to get away from Oregon taxes, capital gain or inheritance. Are you saying if I sold the house in Idaho in 5 years, I'd still owe capital gain to Oregon? And the answer is yes. And basically, the unofficial name for this tax or this provision is a clawback. So it doesn't even sound nice, because you will pay tax on your sale in Oregon whenever you ultimately sell the property that you've exchanged into out of state, which is why Oregon requires that annual filing requirement to make sure you still are holding that property. So Oregon is not going to let you go without paying the tax on the gain that you would have paid to them when you sold the property.
Okay, moving on. I think we've answered our questions. So get this to go. And That's mine. Okay, so here we had a client that called us because their broker told them they should. Otherwise, they would never have known about 1031. So they had a lot on a lake in northern Wisconsin. It had been a family property, they'd inherited like 19 years earlier, and their idea had been to, when they retire, sell their current home here, tax-free, and take those dollars and build their retirement home on that family property on the lake in the north of Wisconsin. And these 19 years had passed, and that became the issue. It's in the north of Wisconsin. And they realized that realistically, that was not where they wanted to spend their retirement years. Well, until a broker mentioned to them this idea of 1031. How about they sell the Wisconsin property, bare land, and buy a rental house here, and her idea was a one-level house that she could eventually live in. And I worried then about her health, and she assured me no, she was fine. But, who knows? And so she sells this lot, non-income producing. It was frankly taking money out of her pocket to pay property taxes every year, to buy a rental house here, one level, income off of that property for now. And if she ever needed that one level style living, she could then, repaint, new carpet, and move into the property. So a very nice personal goal, and a very nice personal goal achieved with that. Very cool. Now I love this one too. So, and we're getting a lot of calls like this right now, where our client is selling a property. They don't need the money. They don't really want to be landlords, but they do have adult children, and they would like to help out their kiddos. So I'm getting a lot of calls right now where mom and dad are selling, they got these gains, and how about, and so we had the client, they had a son and they had a daughter. They were selling a property in Seattle to buy one for the daughter in Bend, one for the son in Portland. And the kids would be the tenants in these properties. And yes, they have to pay the fair market rent, at least, I would say at least for a year. And now, it's a nice way to help out that next generation, and we see a lot of this. What I've learned to raise as a question to our folks is, we can very easily put you into this. We're selling the one rental to buy two rentals, and your kiddos are going to live their fair market rent. That's pretty easy. The question that I raise even at this point, though, is the exit strategy. How are you going to come out of this later on? And there will be a time when the daughter in Bend moves off to Austin. That's pretty popular. And what are we doing about this house in Bend? And do we sell it to buy in Austin, and yada, yada, yada. And so there's a whole bunch of tax stuff around that. So I'm not going into that now, but to say it's a nice scenario to help out those kiddos or whatever, but there will be an exit, and my client should probably be thinking about that even as we're going into this. Mark.
Sure. So the next slide is the mom and dad need to retire. They own several rental houses. The kids do not want anything to do with managing the rental houses. The parents aren't able to continue managing the rental houses. So what are their options? So one of the options that we mentioned earlier was Delaware Statutory Trust, or DSTs, which is a passive investment in real estate. The way it works is, again, as I mentioned earlier, sell the house, you buy a replacement property, is a fractional ownership interest in a Delaware Statutory Trust, DST. And those properties are wide ranging and could be storage units in another part of the country, retirement homes. Again, the list is, really pretty long in terms of what types of investments we're looking at. You get into one of these investments, you're going to probably want to talk to a financial advisor who will then put you in touch with a sponsor company. And the sponsor companies are the ones that do the due diligence and provide and make sure that these are good, sound investments. And then you end up taking the proceeds and from your sale, as well as any debt you have on the property, and the debt in the DSTs is generally available as part of the purchase, which is another nice aspect of it. There's a lot of other details to the DST, although and I won't get into too many of them, but it is passive real estate. Generally, you are locked into the DSTs for the life of the property ownership, as long as the DST company owns the property, which is generally 5 to 7 years. The rate of return, I think, varies anywhere from 4.5% to 8%. Again, depending on what type of property you're looking at. The person you're going to really want to talk to about all the nuances of the DST is a financial advisor, and really do your research on what you're getting into when you do a DST. But it is a really great option for a lot of people, especially later in life, especially in a situation like this where you're trying to get out of passive, real estate, but you don't want to pay the gain on the tax, and you can stay in somewhere else, stay in real estate some other way. So that is really the extent of that. So, do you have anything to add on that?
No, not really. I think, what do we do? Did you say we see 2 to 4 clients a month that will utilize this? Again, they don't want real estate. They don't want the tax bill. They sure don't want to manage. So the DST can be very desirable for them.
Perfect.
Okay.
All right. The next one is, you can see spouses. They had formerly co-owned a building. They got a divorce. So normally, again, one of the other tenets of the 1031 is the taxpayers that are selling need to be the taxpayers who are buying. In this case, the spouses own the property together. They now are since divorced, which resulted in them owning this property as tenants in common. So when the property sells, they are each free, because they both have undivided interest in this property, to take their share of the proceeds and the sale price and go and exchange into something that they want to buy separately from one another. So again, don't see this scenario all that much, but in a situation where you have couples who own rental or income producing property, now are divorced, now own the property as tenants in common, it allows them to diversify, what their holdings are, and they are to go their separate ways. So not a common scenario, but again, shows kind of the utility of the 1031.
Yeah. And I didn't launch our second polling question, and it really has to do with, oh, Hannah, you might need to help me here. It has to do with where everybody is geographically is located. So let's just see if we can get there. Nope, we've done that. Well, we will do that when I was just curious. I think we have people widespread, but I'm not getting to that second question for some reason. But it's not terribly important. Okay, so yeah, once they get divorced and it's final, then they're tenant in common, do whatever they want. But while they're still married, they're stuck together, and that can be problematic for my folks that are separated, trying to go separately, but cannot do it at the time of a 1031. Okay, so now a personal goal again. A client of ours who had good estate planning advice and were not well. And they had a son and they had a daughter, and the client had a single commercial building. I suspect it was a business owner, and this is where their business had once been located. They sold the business, but still had that one large commercial building. And they know they cannot leave that one building to the 2 kids to co-own. They will not be able to do that peaceably. And so what our client was advised to do was the 1031 exchange right, in those latter months. And so he sold this single commercial building to buy 2 replacement buildings as equally valued as possible, so that in the estate plan, in the will and the trust, one would go to the son, one would go to the daughter, and then the hope was that the kids could still get together over the Thanksgiving turkey. So we will see once in a while folks are doing some estate planning and a 1031 to restructure their holdings will become a part of that. Personal goal, bed and breakfast operator. Okay, this is a little older. Bed and breakfasts aren't probably doing all that well right now, but a bed and breakfast operator who was getting out of the business and wanted to buy bare land. And bare land is like kind with the business part of that property being sold. Let's just stop for a moment and talk about bed and breakfast properties. They really are mixed use properties most often. The client lives in a portion, business operation is in the rest of that property. So they'll get tax-free primary residence treatment on the piece they own. But there's this, say 80% of the house is business. And I thought I might be in the business long enough to see this one scenario. I've never seen this. I've never seen a bed and breakfast operator sell and buy a bed and breakfast. They've never gone that way. So here, what was our client doing? She sold the 80% of the, she sold the whole house, but 80% of that was investment, 1031 business property. And we were able to then buy bare land adjacent to her new primary residence. So she have a nice view. And it is like kind. And the gain in the bed and breakfast, 80% will transfer to the land, but because there's no structure there, she'll have that recapture. But otherwise, perfectly good scenario.
All right, maybe we'll we'll knock off a couple of the questions real quickly too. So one question is, if you have rental properties that my two daughters will inherit after my death, what are the issues for them if they want to sell some or all the properties? Well, at your death, your daughters would get a step up in basis in those properties, and then they could sell those properties with that stepped up basis and pay no tax, or they could obviously continue to run those rental properties as well. But it wouldn't have an impact on them outside of the fact that they get that step up basis.
One thing I'll throw in here is when we are on the phone with your clients and we're talking through what it is they want to do, something that we're listening for is how long have they owned the property? How did they get the property? And if they say they got it from mom and they inherited a year ago, yeah, they don't need us because they have little, if any, gain in just a year's holding. So this does come into our discussions with your clients as they call and bounce things off of us.
What restrictions might there be on 1031 exchange on properties held in trust? Normally, if properties are held in the trust, it's a living trust and it's disregarded for tax purposes. So the trust is selling, the trust is buying. It really doesn't have an impact on the exchange. If it's an irrevocable trust with its own taxpayer ID number, then that irrevocable trust must sell and buy, and that must be in the same name. Really, that's kind of how that works in terms of trust.
Yeah. I think there's a question there from Cheryl about Oregon, Idaho. So Cheryl, probably best for us to get on the phone and have a good thorough conversation on that to get you the answers you're looking for there. Okay, and let's see if I can advance the slide.
All right. Oh no, we hadn't quite got to that one.
Back again. Okay.
So that's all right. So exchanger is selling a large whole place to a corporation for $2 million. They don't want to sink all the proceeds into real estate. So this is a situation where this exchanger's biggest asset and really only asset was this facility, and they did not want to take that $2 million and put it back all into real estate. They needed some cash, and so they decided to take cash out and do a partial exchange. And in this situation, it was a perfectly sound decision because they did not want to. They took cash out, they paid tax on it, but now they have that cash. It was a partial exchange. They had a lot of gain in this property. So what they ended up purchasing still deferred, significant amount of gain, but it really met two needs. It kept them in real estate with some income being generated off of that, but it also allowed them to get much needed cash out of this illiquid investment that they were holding. So it really met kind of their life goals in that sense.
Mark, this brings to mind too, that study we have out there where about partial exchanges. What was the percentage again? A third paid some tax out of the sale of a property. Was that the number?
Yeah, so on 33% of all 1031 exchanges, tax is paid in that year of the exchange. And that tax can be due to, again, taking cash out at the time of sale in a partial exchange. There's also always going to be items on the settlement statement that are taxable because they're not like kind, whether it's taxes or prepaid rents or different things that are actually not real estate that are going to be taxable. So there's always going to be, it's a tax deferred exchange, and that tax deferral relates specifically to the capital gain in the property. It doesn't relate to every aspect of that property. Now, that being said, oftentimes there are corresponding business deductions that relate to the rental property that will be taken elsewhere. So you may see some tax coming out of the exchange on your form that you complete to report the exchange, but then there's offsetting deductions elsewhere where you're, showing your deductions for your rental property. So again, to your point, in 1/3 of all exchanges, some tax is paid, in the year that the exchange happens. So.
Mark, that brings to mind another statistic. I know we've had some questions about, well, if you die owning the property, a stepped up basis, you don't pay the tax, the kids don't pay the tax. But that was it the same study that showed that not very many people die owning.
88% of all exchanges result in a taxable sale. The next transaction is actually the taxable sale. It's not an exchange until death, and you get to step up in basis and avoid any capital gains tax. That's a really common myth and one that's used to argue against 1031. And we're going to touch on that in a few minutes anyway. But people argue against 1031, some of the legislators that say, 1031 is a tax loophole. It's only for rich people. Again, Toya mentioned the volume and the level of, sale that we're talking about most of the time. It's really not. It's really, for, properties that are right around that $500,000 or less. But, it is not a loophole for the super rich to, hold and exchange and get a step up in basis. Tax ultimately is paid on 88% of those exchanges in the subsequent transactions. So.
And these stories we're going through really illustrate for our client, and we're about to get to the business goals, but for our client, they are doing an exchange now because it is right for them now. But 7 or 8 years or 9 years from now, no, they'll just take their money. Yes, they'll pay the tax. So it's because they've got these goals that are right now, but down the road, they'll have different goals, at which point 88% just cash out. So, okay. This is me. Okay, so this was a fun one for me. I had the daughter on the phone with me, and Dad had exchanged over a lifetime. And okay, Dad did end up dying, owning several rentals, duplex, maybe 3, 4 properties. So the kids got a stepped up basis, yes. But the kids held on to the properties themselves. And so she called me because they had held on, and kids were all getting along, co-owning. But the time was right, and they were about 8 years since Dad's passing, and they had gains, and Dad had taught them that you exchange. And so here they were calling us to set up a 1031 exchange to do just what Dad did. They learned at their father's knee. It was very cool. Now we're into the business goals. And Mark, I'm handing it over to you.
All right. So here we had an exchanger selling a ranch and breeding operation in Nebraska to buy breeding stock in Oregon. So this particular exchanger had approximately $10 million of gain if they would have sold the property in Nebraska. And rather than pay that gain, if there was exchange was not an option, they said they would just die on the ranch. And this is exactly what we're talking about when we're talking about 1031. It allowed this person to exchange out of their property in Nebraska to a different type of property or different property in a different state in Oregon without having the tax friction, and allow them to meet their business goal of relocating their ranch. Now, if this wasn't available, 1031 wasn't available, they would have stayed on that ranch and they would have died on that ranch. 1031 was enacted, 99 years ago in 1921, and it was specifically created for these types of situations, for people to stay invested in real estate in their full amount, and use those deferred tax dollars that would otherwise go to the government to stay in productive real estate. And over the last 99 years, it has really facilitated the real estate economy by allowing people to make decisions, by taking the tax portion of it tax hit out of that decision. And that's really the underlying benefit of the 1031. Again, we had talked about some of the people arguing against 1031 and, not getting super political, but you are going to hear over the next, 7 to 9 months, in the elections, some of the different tax plans out there on both sides of the aisle that could have significant impact on 1031. The Biden proposal, suggests eliminating 1031 altogether. There's some rumblings from the Trump camp about, having permanent expensing of improved structures, which would also basically render 1031 pointless. Toy and I, over the last month and a half, have been on several, Zoom calls with different Congress people, who are close to Biden, some of the Republicans, basically just educating them about 1031. Number one, that 1031 is, again, not for the super rich. It's for, kind of people who have used some of the rental real estate as their 401k, if you will. And it is very important that they understand this, because a lot of the, I guess, news and, different types of articles talk about 1031 as related to, only available to wealthy people who are seeking loopholes. And that's just not the case. And it's just not what 1031 was enacted for 99 years ago. So again, we're kind of fighting that battle, over the next several, probably over the next year, trying to educate people, trying to make people understand that removing 1031 from the real estate economy right now would be really devastating to that portion of the economy itself. So, and that I guess was a little bit more there than maybe you needed, but that's really this example kind of shows that as much as any of the other ones, I think. So,
yeah, Well, I was going to throw in there that one of our studies too shows that 1031, if eliminated, would cause a contraction in the economy. Again, it's going to stagnate business owners, and it's really largely used by small business owners. And so making that available, admittedly, it's middle class and up. It does not, although it provides housing for, working class, but it's for small business owners. And so we're just trying to keep that message in front of Congress. I have to smile at this slide because, in fact, when I would talk with Joe, or I can't remember his name, the girls were always moving in the background. He was out there with his cell phone talking to me while he was working. So it was a fun scenario.
All right, next one. Again, this just kind of goes to showing the way that you can use 1031. So the exchanger, retired from Texas to Montana, had several rental properties in Texas where he lived, was moving to Montana, and wanted to maintain the rental properties because it was a great income stream, but didn't want to maintain the rental units in Texas, from his new place of abode in Montana. So he started selling the rental homes in Texas and buying rental homes in Montana. Again, just meeting those business goals. Wants that rental income, wants to make sure he's available and around to where those rental houses are. And so he just relocates them from one place to another.
Well, and one more thing too, he was doing multiples, wasn't he? He was selling one to buy two or three. And so he was building that portfolio. Yeah, it was really a cool scenario. Okay, another business goal. We had a client who was in the hazelnut biz, and they knew that the adjacent orchard was going to come up for sale at some point, and they kept their eye on it, and they kept their eye on it. And when they learned that that owner was ready to sell, they immediately put on the market a rental house in Dallas, a rental house in McMinnville, Dallas, Oregon, and liquidated those two in order to acquire the replacement orchard. So the gain in the two rentals moved over to the new orchard. There, the depreciation deductions, again, we have to recapture that. Depreciation in the two houses, that depreciation schedule does not move to the orchard. Orchards do have their own depreciation schedules, but it's different assets, so they would have to recapture. But as much as anything, it was a way for them to amass the cash that they needed to buy that adjacent property and expand their nut growing operation. And I think too, Mark, isn't it true? One of our messages to Congress is how 1031 allows for business owners to, what's the word I'm thinking of? Repurpose. Yeah, because we're seeing a lot of properties right now with COVID, retail properties, restaurant properties, maybe office buildings like we're sitting in right now with almost nobody in the building. So we do anticipate shopping centers. We do anticipate that 1031 will be useful in future when it comes to what are we going to do with this building now that's underperforming. No longer is that its highest and best use. And 1031 is often used like this to repurpose or reposition to a better business model. So
yeah, that's exactly right. Commercial real estate is going to undergo such a significant transition, with everything that's gone on, and having the availability of the 1031, so these properties can be repurposed is really going to be critical. So the next scenario or example, is actually one of mine. Obviously, Toya has the majority of these, even though I'm speaking to them because she's had so much experience. But this is one I did last year, which I thought was pretty unique and interesting. We had an exchanger selling a Dairy Queen in a small town in Arizona to buy multiple rental in Salt Lake City, where their kids and grandkids lived, and they were moving. So they had owned this Dairy Queen for almost 20 years. And they had really been their life. They had kept it up, and it was, a great property for them, key location in this small, drive-through town in Arizona. They wanted to get out of the business so they could relocate. And then they wanted that rental income to continue on. So they were able to buy, I think, 4 rental homes in new development in Salt Lake City area. So the key, one of the interests, so obviously you see kind of the like-kind rules here at work. And again, that flexibility and achievement of personal goals. But one of the interesting things about this was they had some good advisors working with them, because if you look at a Dairy Queen, you're going to say, okay, how much of that is real property and how much of that is personal property? Well, obviously the personal property would not be exchangeable. So in the contract, when they wrote up the purchase and sale agreement, they specifically allocated, the portion, the largest portion, whatever they could include in real property, so they could get the most, that leverage those proceeds as much as possible. Obviously the personal property on the settlement statement came out, those proceeds were paid to them, they were taxable. But again, they had some planning in place ahead of time in this type of deal. Is very important. And it was able to be structured in a way that maximized the value of the 1031 for them.
We've got a couple of questions. Let me take the first one, Mark, while you look at the second. I haven't looked there yet. The first one has to do with seller financing. So say the client is selling a property for $350,000, the relinquished property being sold for $350,000. The buyer has offered $100,000 down and a note for the other $250,000. We have had more of these conversations recently as well, financing being an issue right now. And so a seller finance sale does complicate the exchange pretty dramatically, because as Mark said earlier on, if we sell for $350,000, conceptually, we need to buy for $350,000. Okay, take off commissions and closing. Well, but we don't have $350,000 to work with. We have cash of $100,000 and a promissory note for $250,000. It's gonna be difficult to buy a property with that kind of proceeds from a sale. Most often, I'll go there first, most often 1031 won't work. All we have is $100,000, and our client getting that note of $250,000, they're taxed on it. And now they're taxed as they receive the payments over the course of time. When the balloon payment comes in year 5 or 10 or whenever, then they take the rest of their tax hit so they can stretch out the tax bill, but they're getting taxed fully on that $250,000 note. So if all we have is $100,000 to work with, once we look at the math of their story, probably not workable. One way that will work, and where we do most of our activity, is we get the $100,000 of cash. The note is made payable to Butler, literally. We're holding their cash and we're holding their note. Butler is holds that note. And then your client, either they themselves or their grandpa, or I don't care who, comes in and buys the note and converts it to cash. So if they've got somebody with $250,000 available for this to buy a third-party unseasoned note, then we can sell it to somebody, convert it to cash, and now we got the $350,000 we need to work with. But if they don't have somebody with that kind of liquidity that wants to buy this note, 1031 probably won't be useful. But again, that scenario, we have a lot of discussion around that to determine if it's going to be workable as an exchange. Generally not.
All right, I'll go through this next question. It's pretty interesting. So what if I buy a single family property next week through an exchange with the intent to rent and are unable to find a tenant for this property for 2 years due to COVID extenuating circumstance? Can I count the 2 years formally advertising for a tenant as years toward the dream home exclusion? I had a 5-year prior history of owning 3 1031 rental homes, so this is my business. Well, unless it's a primary residence, you're not going to be able to claim the exclusion. And that, in this case, that's not going to be, allowable here. But I'll slightly tweak this, question to what happens if this happens? What happens if you buy a property, in an exchange and attempt to rent it for a period of 6 months, 9 months, whatever it is, and you make a legitimate attempt to rent it. And for all the reasons that are going on right now, you're forced to move into it. Or some other thing. Will your 1031 exchange be disallowed? Well, there's actually a case that's somewhat similar to that, is if extenuating circumstances exist and your intent at the time was to rent it and you show a good faith attempt to have rented it, and then circumstances dictate that you move into it, obviously, ultimately when you sell it, there will be some gain associated with it because we're talking gain deferral. But it would not most likely, again, I would always say talk to your tax person to make sure they would be okay with it. But it would most likely not blow up your whole exchange by the fact that it was never actually rented, because of all the reasons you would be able to show that you did have the intent to rent at the time that you purchased that property.
Okay, and on to our, let's see, next slide. Here we go. So now this scenario might sound like flipping, and flipping doesn't work. Rentals, yes, but not flipping. Flips are inventory, properties held for sale, new construction for a builder, lots created by the developer, and flips are inventory properties and 1031 is only for investment. What I'm about to describe is not flipping. So we've got the client, exchanger sold a few years ago in California, bought a property in Washington. Now they're selling in Washington State and they want to buy in Texas. And so this illustrates a certain component of our client base that are not geographically fixed. They are selling high in California, take the dollars to Washington State, they perceive to be, priced lower, wait for those prices to come up, sell high in Washington, take the dollars to Texas, and they're really shopping all over the country for opportunity. So this totally works, and it's kind of exchange. I will say we've had a number of exchanges recently where they're selling here in a high price point market, taking the dollars to Missouri or Indiana or Alabama. And again, like Mark's earlier scenario, they can buy multiple properties in those locales generally. So they're looking for opportunity and they're comfortable owning real estate that's elsewhere in the country. So we're happy to work with them on each of those exchanges. Here's one of my favorite exchanges from a year or so ago. Very cool deal. Now, this isn't necessarily going to sound to you like real estate. Well, part of it won't, but it is. And remember, 1031 is only for real estate. So we had a client from Eastern Washington, and he owned a grain elevator. And he was selling a cell tower easement off the side of the grain elevator. And an easement is absolutely an interest in real estate. And it's eligible for 1031. Well, what was he going to buy as replacement property? The dirt underneath the grain elevator. He was buying that from the railroad. And railroads don't sell very often, but here they were willing to sell to him, selling a cell tower easement to buy the dirt under the grain elevator. Absolutely like kind. Very, very fun.
Okay, the next one, client selling water rights in Utah. So in this situation, client had a rental house in Utah that had very little gain, but on that property, there were water rights associated with it that were significant. And again, water rights, like an easement, are considered real property. So this individual was able to sell their property, the entire property, even though there was very little gain in the rental house, and in and of itself would not have been probably worth doing an exchange. They could leverage the water rights and the gain with those water rights to buy a property, a rental property in Yakima, and continue their investment in real estate. So again, you have these situations where things you may not think of right off the top of your head. You look at a rental house and say, there's no gain, there's no way to do a 1031. But if there are other aspects to the property that are available, we just had a question last week, there was a sale occurring and it ended up probably not end up being an exchange, but not for the fact that, wind rights were involved, and those would have been exchangeable as well because they are considered real property rights. So again, a different type of scenario, but you really have to look at the full scope of these transactions, to see if there may be an availability of the 1031 option, if it fits.
Mark, before we go to the next slide where we get into business and personal goals, I think we should stop and talk about reverse exchanges for just a moment. It is, again, we don't have improvement exchanges in this presentation and we don't have reverses, but we're getting so many questions right now, and I think we have a bit of time. Reverse exchanges. So your client with that 45-day deadline, and there's so little inventory and they're just so stressed about it that they really want to go out and buy something first and sell later because they know they can sell theirs fast. We probably get 5 of these calls a day. The phones are really ringing off the hook, people. we love, that's music to our ears. And probably 5 a day, they're asking about, can I buy first? Can I buy first? And the easy answer is yes, you can. But then, kind of like with improvement exchanges, there's 2 rules we need to discuss. So the IRS will let your client buy the new property first, sell later, but they won't let your client be the owner of both properties at the same time. Sounds kind of familiar, doesn't it? Well, they can't be the owner. What do you mean? Of course I'll be the owner. No, you can't be the owner of both at the same time. So what happens is, again, the exchange company usually, and again, there's no cookie cutter for these, absolutely none. Usually though, what happens is we go to buy the new property, the seller deeds it to the exchange company. We have to set up LLCs and one thing and another, and we will be the temporary owner of the new property, which we can only own 180 days. But That's the second is this deadline of 180, but that's not going to be an issue in most cases because you know you can sell their relinquished property within the 180 under the current circumstances. Although I had a call yesterday and it's a more difficult sell, and they thought it was 6 to 9 months to get the building sold. Well, that's going to be a problem. I can only own 180. So reverse exchanges are possible. The one thing I'll throw in is that, of course, the fees are higher. In a normal exchange forward, our documents are fiction. We're pretending to sell, pretending to buy. So the fees are very flat rate and nominal. But in a reverse or an improvement where we're the temporary owner, then the fees are higher to us because it's not a pretend, it's a real. And our accountant has to put the ownership of these properties on our tax return. And gosh, they charge us for that. And the LLCs and working with lenders and everything else. So of the 5 reverse calls a day, we might do 5 a month where we can really pull it all together. First of all, your client has to have the financial wherewithal to buy the replacement property. Had people think that our fee was higher because we were going to loan the money for the purchase. Oh my gosh, no, we'll just be the owner for that fee, but we won't be, we have no money to bring to the table. It's all got to be out of your client's pocket. So reverse exchange is doable. They are a nice way to deal with that 45 days, but they are expensive and they may have additional transactional costs, maybe recording of deeds, title insurance. So a reverse exchange and improvement, I think at rock bottom would be 8,000. When you add up all the damage, 8,000 rock bottom could go on up to 10, 15, depending on the complexity of the scenario. So do know that it's possible. And the fun part of our work really isn't the paperwork that we're producing in here. It's the answering these questions for you, your client, the advisors. I see a question about mineral rights. And yes, mineral rights are considered like kind, just like water, air. So mineral rights are, and we see clients who will sell rental to go buy mineral rights as their replacement property, oil and gas. So yes, they totally qualify for that.
So there's a good question we can, because it delves a little bit into partnership, which we're not going to get too deep on, but I have a duplex and looking to sell up either more expensive duplex or more units, more properties. Can my partner contribute to the new purchases to improve our portfolio? So the rule, again, as we mentioned, is the taxpayer who sells has to be the taxpayer who buys. And if you are the only owner of those properties and you are looking to buy replacement property, you can buy with somebody else, but you have to buy the property as a tenant in common, meaning you have to bring in cash, somebody else has to bring in cash. You have to have a pro rata purchase of that property as a tenant in common. You need a tenancy in common agreement. It really needs to be treated as your own separate interest in that property. You cannot have somebody else contribute to that and buy in a partnership and exhibit partnership behavior, which is basically owning a property, co-owning a property with somebody else and sharing in the benefit, evenly with them in that property. So anytime you're looking to add somebody to the 1031 transaction, we really have to have a thorough conversation about what is going on there, because if you end up buying a property and the IRS considers it, that you purchased a new property as a partnership, then we're talking about a different taxpayer. And then you are talking about having an exchange disallowed because you really didn't buy and sell as the same taxpayer.
Mark, I've started with those conversations. I start off saying there's right ways to do it and there's wrong ways to do it. And then we have to explore and see what we can come up with. So
that's right.
Okay, now we come to mixed personal and business goals. Looks like this one is yours, Mark.
Yes. So this is similar to, the situation that Toya described with the bed and breakfast. So you have a client selling a rental unit, it's part of their house, an ADU, if you will, and they're selling their primary residence. It's attached. They've taken depreciation on this ADU. They've allocated the portion of taxes, depreciation, interest, whatever else. It's been treated as a separate business unit. So when they go to sell their property, they will allocate that portion of the ADU to the 1031 and they can exchange that portion. So if there's significant gain in the property and thus corresponding value to this ADU, then, and the also benefit of depreciation recapture, they can certainly exchange out of that and into, if they're buying a new property that is associated with the primary residence and another ADU, we can allocate that portion of the purchase to the rental portion of that property. Or if they want to go and buy something completely separate, well, they take their primary residence, replace their primary residence, and then take that ADU portion and go buy bare land, commercial property, single family rental. Again, all your options would be on the table at that point, but you're really treating it separately as a separate transaction. So
Yes, these are really mixed use property, as you said, Mark, and you as a broker, if you're taking the listing of something in whole or in part, rental, commercial, or land, that's an opportunity for exchange, and that's when you, the broker, ideally would alert them to, 1031 and needing to talk about it. Okay, there's a question here. What about the loan on both the home and the ADU? Yes, the loan would be an encumbrance of the whole property. So the ADU would be responsible for its share. And so if the ADU has been written off as 20% of the property, then our client selling that ADU in a 1031 would need to replace 20% of the debt that was against the particular property. So it is part of the equation, even for the ADU. Okay, and I told Mark I wanted this story because it looks, and he doesn't believe me, but it looks a lot like my garage. Because my husband has had an old truck in there for about a decade now. I'm trying not to count the years. Well, so the story though is you've taken a listing of a property that is their primary residence, and there's a shop out back where the husband is running, or the spouse is running a business. So you're taking the listing of a property that is partly primary, and there's maybe a landscaping maintenance business that he has going there at the location. So that is an opportunity for exchange. And we really, for you, the broker, and the real two messages for you, the broker, is that out of this whole class, the ability to spot the opportunity for an exchange, that it's rental or commercial, call that commercial activity there on the screen, or land held for investment, in whole or in part. If you spot that as an opportunity, rental, commercial, land, and you raise it to your client, then you really are out more likely to be working with them, looking for that replacement property, picking up the second or third commission. So spotting the opportunity is critical, rental, commercial, land, and then, I'm not at the last slide yet, but the last point is knowing that we're a resource. And that is what we do all day, is on the phone. And Mark's an attorney, I am, and we have Kelsey who's an attorney, and we've got a paralegal, and we've got no billable hours. We're just like all the other exchange companies where they can bounce their questions off of us and see if their scenario is going to lend itself to a 1031. And Mark.
yes, so here's where clients sell their home where they have a large parcel of land. Again, we're talking about an allocation here between the primary residence, and let's say it's 10 acres or more of property, and the house and adjoining land is an acre. That would be treated as a primary residence, and then we would basically do an exchange on the large parcel of land. And this actually scenario could go both ways. In fact, just last week, I did an exchange where the exchanger sold their primary residence, wanted to buy a primary residence elsewhere in Eastern Oregon, and they also had 2 rental houses that they wanted to sell. So on those rental houses, we sold into an exchange, and then they bought the land portion associated with the property that they were putting their primary residence on. So they basically exchanged 2 rental properties into a large piece of investment land that also happened to be adjacent to the home they just built. So it really met their need in terms of getting out of the rental business, investing in land that was going to be used for some commercial purpose, but also was next to their primary residence, which they were able to sell and buy in a normal, residential transaction. So again, kind of a neat scenario there with regards to the home and the land adjoining, that home.
And our last story, which I told Mark I had to have as well. So here we had, the couple were actually in my office. And when the wife and husband found out that all real estate is like kind with all other real estate, and they were selling a rental house, and she was like her elbow in her husband's ribs, honey, how about, they were out in Gresham, and how about, there was a cute little house on Main Street, and how about we buy that little house, and you know how I've always wanted a chocolate shop, she says. And so is it like kind? Is it like kind? Yes, yes, it is. Sell a rental house to buy a replacement property where she's going to conduct a business And I'm not saying that it's a good business move, because you know, how long do chocolate shops really stay in business? But it was totally like kind. She could have done that if she could have talked him into it. And she and I were all over the idea, because I haven't had my chocolate yet today, so I'll be finding some shortly after the class wraps up. I'm all over chocolate. So totally like kind, absolutely something you could do if you can talk your spouse into it. Now we've got a slide up here for questions. We've taken a lot through the course. I'm going to just put up our contact information. And Mark, do you want to check this last question here?
Yes. Client wants to sell a building, but buyer is requesting a 12-month escrow holdback on a portion of the funds. Example, $100 sale price, $28 escrow holdback. Initial funds to seller is $80, with $20 released to them from escrow 12 months later. Does this impede my seller's exchange? It does not, although the $20 in that example then just would not be eligible to be used in the exchange. So that, I mean, it doesn't really matter, but because it's outside of the deadlines of 180 days, you know, escrow would eventually cut them, you know, that check for $20 in a year, but you'd be taxable on that, and the exchange would only be eligible to use the $80 that was in the exchange at the time of sale.
Yeah. And the truth of the matter is, isn't it, that so often the only way that deal is going to close is with some sort of an escrow holdback. And there's like no real way around it. We spend a lot of time trying to figure out, well, is there some other way to do this? Well, yes, if our client wanted to bring $20 to closing and their $20 funded the holdback. But if it's coming out of the sale proceeds and that's what's needed to close the deal, then that's what's going to happen here.
And that's a good question, because, and that, I mean, that is a really on point question for what's going on right now because of a lot of the holdbacks being required by lenders. So we've actually had that question a little bit in the last month and a half, just because I think we'll see it more and more, you know, in the near future. So a good question, and thanks for that.
Well, we are a little over time and we are at the end of our material, and we welcome really, if you have any questions beyond this material today, please just give us a call. We wait for that phone to ring. It's our favorite thing. I think I said that. And so for our folks that are getting, you know, continuing education, watch for emails coming from Hannah. She'll get that taken care of for you before she heads off to get her master's next Friday. I'm going to cry when she leaves us. So she's heading back to get a master's. I don't recall, Hannah, what is that degree going to be in?
It's in urban and metropolitan planning. So.
Cool, cool, cool. So she'll get those certificates out before she heads out the door.